Are markets overvalued here? And some buyback stocks. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. On our last live stream, we were asked about companies that have buyback plans, decent cash flow. So we're going to take a look at some candidates. But before we do that, I wanted to talk a little bit about equity market valuations. So I happened to read an article last week that was talking a little bit about the equity risk premium. And of course, whether or not the market is overvalued at any point in time is very much a matter of perspective, right? So by what measure do we establish what the value of the market is, and to what are we going to compare it? So equity market valuation metrics are financial ratios and indicators used to assess the value of a company's stock relative to its earnings, assets, sales, or other financial measures. And these metrics help us determine whether a stock is overvalued or undervalued or fairly valued relative to their own history, to the broad market, or to their peers. And the most commonly cited equity valuation metric, and the one we'll use for our conversation, is the price to earnings ratio. The price to earnings ratio basically measures what investors are willing to pay for every dollar of earnings. And it's calculated as the stock price or the index level divided by the earnings per share or per unit. So as many will know, a high PE can indicate overvaluation, but it could also just simply represent investors' expectation for very high growth. So especially in sectors like technology, you're going to see that stocks have very high PE ratios, and that's really just investors betting that future earnings are going to grow quite significantly. Similarly, a low PE can signal that an asset is undervalued, but it can also suggest that the market expects slower future growth or sees other risks that could cause declining earnings, management issues, or competitive threats, anything like that. So low PE ratios are frequently seen in companies that have more cyclical earnings. So companies that have greater earnings volatility. So cyclical businesses will appear undervalued when they're doing very well, and they're going to seem overvalued when their earnings are quite weak. Valuation metrics like these can also be used for the overall stock market. So we can apply these to the S&P 500, assuming we have the data. And the S&P 500, of course, includes all kinds of companies, including those fast-growing technology businesses, more stable businesses like staples and utilities companies, and much more cyclical businesses like the home builders and energy companies and industrials. And consequently, these ratios often provide historical perspective on whether investors are generally optimistic or pessimistic about growth, whether it's expensive or not. So with that in mind, why don't we just take a quick peek here at the S&P's valuation, which at the moment is about 26 times earnings. So I don't know if you can see my chart here. Yes, you can. Okay. So these column charts that you're looking at right here represent the price to earnings ratio on a trailing basis for the S&P 500 going back more than 30 years. So I have data here, as you can see, going back to, I think it's late 1990. We can also take a look at this relative to forward earnings, but I want you to notice something else. So this other line in this chart right here that I'm highlighting at this moment, this is the actual sort of earnings per share, if you will, for the S&P over that time frame. And one of the things you're going to observe is that very often when the PE ratio went high, as it did here in, say, 2021, that period, back here, 2008, 2009, one of the things that you are seeing is the fact that earnings fell sharply. So two things can cause a PE ratio to rise. One, of course, is rising share prices, and the other is declining earnings. So either one of those will expand the ratio and do so quite materially. And so if you're just looking at the price to earnings ratio in that context, what you'll see is, indeed, I'm going to draw a line here so we can take a look at this. We are indeed well above average. In fact, the average price earnings ratio, I think I've got it over here, is just under 20 for the S&P. But there were periods where it was slightly higher. Now the question, one of the questions that we want to ask ourselves is, does that mean that the market can still go higher now? Are we at a moment of potential risk? Well, we are at an above average market multiple, but we are not at an above average market multiple because of a recent precipitous decline in earnings. Now, earnings actually over the last couple of years have not grown as quickly. So those of you who watch this live stream will know that on many occasions I have said that S&P earnings on average grow by give or take about 6.5% or double the rate of GDP growth in general. Of course, that chops around a lot because in the great financial crisis, S&P earnings plummeted, and they plummeted because financials had tremendous losses. So that sucked a lot of the earnings out of the broader index. But the point that I'm making here is that if the price to earnings multiple is extremely elevated, even though we haven't had a recent decline in earnings, well, there's two things that we could possibly expect. One of those is that earnings growth could accelerate back to a more historical norm. So to put things in perspective, over the last 2 years, S&P earnings growth is actually closer to 4% than 6.5%. So is that because, in real terms, they're not growing as quickly? What are the potential causes of that? So when we look at this price to earnings ratio, I wanted to look at it a slightly different way, and that's what I'm doing here. So this is another price to earnings growth chart here. And let me see if I can sort of expand this. I think I can, so that we can see this a little bit better. Get rid of that. And that thing is in the way. Okay. So what did I do here to change this chart? What I did was I just assumed earnings growth at a linear rate of about 6.5%, right? So what I'm doing is smoothing out those earnings gaps that we saw. And by the way, this is kind of interesting too, or you might find it interesting. I found it interesting. And that is that if you take a look at S&P earnings from January of 1991 to present, they've grown more than ninefold. And if you're trying to reconcile that with the growth rate that I was just talking about, of about 6.5%, and you would say, well, if I extrapolate that growth rate from a 9.3-fold increase in earnings, and I work that back, you're going to end up with a higher compound annual growth rate than the 6.5% that I'm talking about, closer to 6.9. So you're going to say, well, did Mike do the math wrong? So just to clarify, when I come up with that 6.5%, I'm accounting for the fact that we periodically have economic setbacks, debt crises, and things like that. And that creates earnings gaps. So what you expect to get is not simply a function of a linear extrapolation of earnings growth, but it is that anticipated rate of growth plus the anticipated setbacks that you're going to get from time to time as a function of the pandemic, as a function of the GFC, as a function of a recession, those types of things. And so when you make that adjustment, that's how you kind of get to that number. So if you said to yourself, okay, well, 10, 20, 30 years on, what do I think the S&P earnings are going to be per share nominal, you would use a higher growth rate than you use when you're actually calculating what you as an investor are likely to receive. And that discount is about 6% over the course of the last 35 years or so, which is about the amount of time that I had. So anyway, what I've done on this chart is I've essentially created a smooth earnings growth trajectory and then divided the S&P level by that number through time to give us a better perspective of where we stand relatively. And what we find, and it's not as easy for me to annotate on this screen as I can on the Bloomberg screen, but what we find is that, yes, there was a period since 1990 where valuations were higher than they are now, but just one. So we reached this level in 2021, and then the market fell. We had a bear market, as all will know. The period where we had higher valuations than we do right now are basically from late 90s through 2000, early 2001. So the only time within the last 35 years where valuations using this methodology have been higher than they are right now was in the tech bubble. So you can think about that however you choose, but I think it's interesting and something we probably want to be aware of. All right, so this is another way to think about market valuations. And this is what's known as the equity risk premium. So what is the equity risk premium? What I'm doing here is I'm taking a look at the corporate earnings yield for the S&P, which is the inverse of the PE ratio. Right? So if the PE is 20, then 1 over 20 is 5%. So effectively, because you can think about it this way, right? So as I said at the outset, the PE ratio is the amount that an investor is willing to spend for a dollar's worth of earnings. And if you invert that relationship, it's essentially the yield, the earnings yield that the investor receives for their investment. And the equity risk premium is the relationship of the corporate earnings yield for the broad market to 10-year treasuries. So basically, how much greater is the corporate earnings yield that you get from equities to compensate for their additional risk relative to the risk-free rate? Now, I'm not saying, by the way, I want to make this clear, I'm not saying that necessarily there should be an enormous risk premium. I mean, we can see that there were several instances where there most certainly was a significant risk premium. I'm not saying that there necessarily should be one, and the reason for that is that S&P earnings are expected to grow over time, and they will account for and adjust for inflation, something that the risk-free rate will not. So there is a risk associated with the risk-free rate that isn't really baked into it unless you're looking at something like TIPS, which arguably I could have done. I didn't think about it here. TIPS being the inflation-protected securities that are a different type of treasury bond. Anyway, my point here is that, once again, we can see that the risk premium, if you're an investor, think of the risk premium as essentially a margin of safety, right? So the larger the risk premium for the asset you're investing in, the more you're being compensated for the risk you're taking relative to other asset classes, like treasuries. And as we can see, here too, the risk premium is quite low. Actually, there isn't one at the moment, and that should make some sense, right? Because if the PE is greater than 26, then the yield is less than 4%, and that's about where the 10-year is, right? So they're basically yielding the same. One of these should, in theory, adjust for inflation and hopefully grow over time, and hopefully grow more quickly than it has the last 2 years. But, yeah, these things, I think it's worth thinking about these things. Now, I have said many times that valuation is not a timing tool. And I don't believe it's a timing tool here either. And as we can see, both the risk premium can become more negative than it is. The PE ratio can get higher than it is. It got over 30 in the tech bubble. But we're getting to a level where, to me, tactical hedging would probably make some sense. Not just because of this, but what else do we have going on? We have conflagration continuing in the Middle East. That kind of thing could cause oil prices. If we have some disruption there, that could cause a spike in oil prices. That's not necessarily going to be good. I think that presents a risk. The election presents a risk. We kick off earnings season in earnest this week with the largest financials reporting at the end of the week in 4 days on the 11th. That's when JP Morgan reports. That's kind of the kickoff, if you will, for earnings seasons now. So what I would suggest is considering putting on a hedge at this point. Now, when I was looking at this earlier, we didn't have a 1% sell-off yet. In fact, I had sort of been thinking about this over the course of the weekend, wrote an article on this topic. And so the trade I was looking at, we're going to see how it's priced right now. I'm just going to look out to SPY. And I think you want to capture all of the earnings season. I think you want to capture the election and maybe a little bit of time thereafter. And the other thing that you're going to look for in this trade is to get a fairly generous payoff. So, we often talk about buying debit spreads and spending less than a quarter of the distance between the strikes for what you buy. I actually would like a little bit more kick, if you will, this time around. So the one I was looking at earlier, and we're going to see where it prices now, because like I said, prices have changed. And this is always the case, right? Your mileage may vary depending on when you do the trade and things like that. I think I was looking at a 565.40, so a $20 wide spread. Now at the time, yeah, this one's gone up a little in value. So this one was offering, almost, believe it or not, almost a 5-to-1 payoff when I was looking at this pre-open. But, do not despair. I don't know that 10 points this way or that are going to make such a huge difference. But, you could take it down 10 points and look at something like the Nov 29th month ending 550-530. That's a $20 wide put spread. Mid-market price, as we can see here, was less than $3.20 a contract, right? So your max profit in that case is going to be, we'll just call it $3.20. Why not, right? So $16.80 on a $3.20, so that's 5 1/4 to 1, not including transaction costs. And also, you're looking at, not that it's necessarily, because you might just say, maybe you're thinking to yourself, I want to speculate in a bearish sense, so I'm not looking at this as a portfolio hedge, so I'm not going to think about that $3.20 a share relative. So by the way, just some people have asked this question before, how do I size a hedge? Just think about the notional value of the trade that you're putting on. Round numbers, $57,000 per SPY put spread notionally. It's going to be about $565,000, $570,000 if you are doing it via SPX. So what would the SPX trade be? 5,500, 5,300, that sort of thing. And then you can size it appropriately. And you can either upsize this trade, to get more bang if you're betting on a move of about that much, or you can do more, of them, whatever you choose. But we have a lot of things here that could shake things up a bit, and I think it would be foolhardy to ignore it. You can't hedge all the time, and you don't want to, by the way. You don't buy hedges in the GFC. Just going back to that equity risk premium chart, think about this. So in here, the need for hedging is reduced because your margin of safety is built in, because you have more of a risk premium that you're being paid to take the equity risk in the first place, right? So one of the reasons I like to look at equity risk premiums in this way is because, it helps you identify when hedging is more appropriate or less appropriate. And you can see that for a significant period of time here, it probably wasn't appropriate because you were being well compensated for the risk you're taking. Now, a little bit less so. So when people refer to tactical hedging, that's what they're talking about. Now, I'll just offer one other thing, because I lived through the tech bubble in the late 90s and early 2000s. So at that time, I traded on the Philadelphia Stock Exchange, the American Stock Exchange. We traded a lot of tech stocks. I was more in the industrials and energy space, but as a firm, we traded a lot of that stuff. And we all recognized that we were in a very dangerous place. Everybody felt that the market was overvalued. This was not a mystery. But hedging was exceptionally difficult because one of the things that happened was that volatility, both realized and implied, really started to go up. So that's sort of the opposite of the relationship that we normally anticipate. Generally speaking, steadily rising markets are associated with periods of low options premiums. But the problem is that when options markets get a little bit toppy, at least in my experience, and there have been publicly traded markets for a lot longer than I've been in the business, and certainly a lot longer than I've been alive, but for as long as I have been doing it, one of the things I have noticed is that when the risk premium gets low, valuations get rich, the markets become seemingly more fragile. That is to say, more volatile. And that makes some intuitive sense. Somebody once referred to it as, investors become like a long-tailed cat in a room full of rocking chairs. They get very jumpy because they know that it's a dangerous situation and therefore are willing to shoot first and ask questions later. And that may account for that elevated volatility. Okay, so that sort of covers the valuation conversation. Now, last week, I was asked by PC, I believe, to talk about companies that had buyback programs, and I'm trying to remember, because I don't have it. Maybe somebody can share it on the screen. You had mentioned some specific names, and I'm going to see whether, or maybe someone can just get PayPal was one of them, and AutoZone, right? Okay, so okay, so let's do this. Got some other names in here. Some will be recognizable to everybody, and others not. AutoZone happens to be on this list. When I was coming up with this list, I didn't remember right offhand the ones that had previously been mentioned, but yes, AutoZone is certainly on this list. But there are many others, and some of them are probably not surprising to anybody, and some of them you might not be familiar with because they're not as well known. Arguably, the most well known is going to be Microsoft, right? So, multi-trillion-dollar business, worth over $3 trillion, but their buyback is immense. So, in this column here, when I put this together for you guys, this is when the most recent stock buyback announcement was made. Ferrari is also on a buyback program, Al Gover is telling us. So, yeah, this list is not comprehensive in the following sense. I identified about 223 stocks that I was looking at earlier today with buyback programs, and I've culled that list down to less than 40 here. So there are a lot, and that's just looking at the Russell 1000, right? So this, by no means is this a comprehensive list of stocks that have buybacks. This is a list of stocks that have buybacks that I think might be worth a look. And what are some of the things that were of interest to me when I was thinking about this? And as you can see, I didn't filter it based on things like market capitalization, in part because sometimes the better opportunities are going to be found in things that everybody's not picking over. And by the way, I wanted to mention one other thing. So this is just an interesting aside. And on Saturday, I was playing tennis with a group of guys that work in financial services in various capacities. So there was a guy who runs a mid-cap private equity shop. Another guy runs a hedge fund. It's inside of a wirehouse, but it's a big hedge fund. And we discussed something that we don't bring up all that often. And I mention this because Microsoft is definitely one of sort of the candidate stocks for what we were discussing. And what we were discussing is that there are some stocks that what I previously referred to as real money accounts. So we're talking about mutual funds and things like that. And I'm actually really referring to mutual funds more than anything else right now. This is going to become clear in a second. So the 1940 Act, it was basically, that's the act that sets the regulations that govern mutual funds. And the reason that's important is because, and I've occupied this space myself, didn't particularly enjoy it, because number one, because it wasn't profitable as a business for us, but the other is that, we were fairly hamstrung. Now, one of the things that you get hamstrung with is that you cannot have more than 50%, you may not invest more than 50% of the aggregate assets of the fund in individual constituent positions that have percentages of greater than 5% of the fund. All right, so just think about this for a second. What that means is that if I have a mutual fund, doesn't matter how many stocks are in it, I could not own 10 stocks, each of which had more than 5% of the overall fund assets, right? So if each was 6, so the 60% of the fund was made up of 10 stocks, and they were all equal weight, you can't do that. You can't enter the positions that way. So that's excess concentration risk. It's not permitted by the Act. However, if I buy a stock, say at a 3% of my portfolio, and it goes through 5, I'm not obligated to sell it because it was actually below at the time. So in other words, I'm not taking investors' money and risking it disproportionately on this stock. The additional risk that's associated with that stock is only additional risk because it's house money, if you will. It's money I've made because that position has become profitable. And what that means is that, and you'll often see this, take a look at real money accounts and you're going to see that in many instances, if they have concentrated positions in things like NVIDIA or Microsoft or Meta or any of these stocks that have really crushed it, the fund managers are in an interesting spot, right? They probably would like to try to take some profits or reduce their risk if they could. But if I bought NVIDIA as a 4% holding, and now it's 9, and I want to sell it, I cannot buy it back. So, because it's going to throw my percentage over. And the interesting byproduct of that is it creates sort of these locked-in holders until they're absolutely compelled to blow it out. So it's important to think about that as you look at some of these really big stocks that have the buybacks, where maybe you're saying, wow, there's a couple guys that have really big concentrated positions, and are they going to start turning seller? It's one of these things that you have to sort of play a little bit of chess, with the whole regulatory environment to kind of decide whether you're going to sell it if you're in that position. So just something to think about. So Microsoft. So this list of names that I have here, these are buybacks that are all over 1% of the current market capitalization. And I filtered that simply, and these are all names that in general I happen to think are okay investments as well. So there are bigger buybacks, and there are companies that maybe are not as appealing. But these are all businesses, and I grouped these by sector so we can sort of take a look in here. AutoZone, which you had previously mentioned, that is on this list. But, we can see that there are some other companies in here that have fairly substantial buybacks as well, like Jabil, which is probably a name that you guys are all familiar with. But Microsoft, big as it is, even with a $3 trillion market capitalization has a $60 billion buyback, so 2% of the float. So that is accretive, and that was the point I was making about Apple, is that at a certain point, the accretive effects of these buybacks are diminished because the value of the business has gone up so much. Diamondback Energy, that one's down here. This is fairly material. Now, whether or not that's going to make some sense is also going to depend a little bit on things like energy prices and so on. But I don't know if you guys want to snap that list or what you want to do with it, or if there's anything in there that you want to dig into a little bit more deeply. But this sort of constitutes a list. Hopefully you can see these. Yeah, you can pause the replay as Jay on the producer side is mentioning. You can go back and take a look at these. And one of the things you do want to do, of course, when you do that, is just check on the status of the buyback and just see how much of it. Now, in this case, you're going to notice that all of these buybacks are relatively, actually, there's one in here that's stale, are relatively recent. So these 2024 ones are the ones that we're really interested in, right? Because when you're looking at that, you're going to be seeing that there's very little of the buyback. I'm going to bring the screen in here. If that chops up, pixelates the screen a little bit, we notice that tends to chew up system resources a little bit. So they will announce the buyback, and this one was recently announced, so of course there's no impact yet. I'm just looking at Microsoft at the moment. So they only announced it less than a month ago, $60 billion. And you can see here, that the remaining amount is the $60 billion. They haven't actually instituted the buyback yet. So that's something that you want to sort of keep track of. And they will report that quarterly, how much they bought back and at what prices. And probably your brokerage platform does that too. They might, I don't know if their chart's going to look like this one, but gives you a sense of what the executions were, when they took place, the approximate prices. Why the approximate prices are important is because that obviously is going to impact the percentage of the float that's involved, right? So when we're estimating the float, we're basing it on the current market cap and the amount of the authorized buyback. If the price declines and they decide to accelerate the buyback, then it would, of course, be more accretive in that case, right? And less so if prices rally more sharply. Okay, so let me get that out of the way. So one last time, if you want to do this, and I'm actually going to, just bear with me for a second. I'm just going to filter this so that you have less to look at here. We're just only going to look at the really recent stuff, if we can. You know what? We can't even get rid of the February ones. Here we are. So I'm going to just let me downsize this one. Yeah, there shouldn't. Oh yeah, that 2021 shouldn't be in there. My mistake. Somebody saw that. Good. So I'm going to get rid of that. Well, I pulled that out, but obviously I missed it somewhere. Oh, there it is. Okay. Let me just downsize this. I'm going to put that up on the screen and leave it there for the count of whatever. Count of 5. So you guys can take a look at that. But these are some potential candidates that have, in a variety of sectors, companies large and small. Now this is taken from the Russell 1000. So it's still going to be mid-cap and beyond. I could theoretically expand that list a little bit. And one of the reasons that you might be interested in doing that is, take a look at Crown Holdings, for example. This buyback is huge. I mean, it's 18% of the float. So, from time to time, you're gonna see that. And now you also might want to then decide, okay, does that make sense? Is that a good business decision? Is it excessive? There's a lot of a lot of people in Washington want to criticize management for buybacks because they think it's essentially just a way for them to pay themselves if they have compensation that's based on the value of the shares, that they are creating support for the share price. But the fact of the matter is that the benefits of doing this versus distributions of other types to shareholders are of Washington's own making, of course, right? Because if you're going to create double taxation on distributions through dividends and things like that, well, then and what's the double taxation? Double taxation comes when you have corporate income taxes, and then you follow that up with taxes on dividends. Now, some investors get what are called qualified dividends, which means that they are not going to pay taxes. So if you are a middle income person with a modest portfolio that is receiving a dividend income, then your dividends may indeed be qualified, so you're not actually paying material amounts of tax on that. But the double taxation does create a problem because it does create these incentives that would encourage things like buybacks. And by the way, buybacks in some cases make sense anyhow. What would examples of that be? Companies like Salesforce and others that have very large employee stock grants, which are just dilutive. So you own a share of the company, and every single time that they start issuing shares to employees and so on, you are effectively getting a little bit diluted. And if the company buys back shares, then effectively that's a way to manage that. So there are certainly instances where buybacks are appropriate and are in the shareholders' benefit, not just management, but it probably makes a really handy talking point for politicians trying to make political hay. All right, Steve Garcia. Hi, Mike. Last Friday, I bought an SPX call calendar, long the Jan 5800s, short the November 5800 calls for 94.80 to take advantage of chop and take advantage of slightly elevated short-term vol. Appreciate your critique. A slightly elevated short-term vol? I don't think it's slightly elevated. I would actually say that it is quite elevated. We have, as we've previously discussed on this live stream, significant event variance associated with the election, which I'm going to show you now in the term structure, and everybody can see it. Just only need to look at one, and here it is. You can see this big bump right here. That's all election. So that can make some sense. I'm going to build this into options play using SPY options because I don't think it supports index. So we can, and you are on the 5800 line, so we'll just use 580, 580. So others can get a sense of what that trade looks like. You're using the NOV 11 weeklies. Oh, no, that's probably a midweek expiration. I'm just going to use the NOV regulars. Yeah, so you've got the NOV 11th 5800s. Those are a Wednesday expiration. No problem. This is going to be close enough. Give us a decent sense of it. So that's what that trade. Actually, sorry, this has to go out further in time. So I've got to get out to Jan. Okay. So in general, I do like this trade. This is what it's going to look like for those of you who don't trade SPX and want to trade it via SPY instead. Looks like the cost of this is going to be a little bit less for those who are interested in taking advantage of it today. The only thing I would say is that, of course, it's going to see peak profits when it runs to the strike. So if it's a straight calendar, the long and short strike are the same. Generally speaking, with calendars, you want, here's what we used to say. If you are short options, you want it to run to the strike. And if you're long options, you want it to run through the strike. Now, that's a vol trader's saying. And what I mean by that is that if you're a vol trader and I sell a 30 delta call, what does that mean? I sold a call that is out of the money, 30% chance that that's going to expire in the money. That's also the hedge ratio. So if I simply did a one-up hedge, so I sold 100 calls and bought 3,000 shares of stock, the best possible outcome for me at expiration is for it to run to that strike, because I'm making money on my long stock, the hedge, and the call goes out worthless, right? So that's kind of the ideal thing. So that's why we say we want it to run to the strike if you're a vol trader. Through the strike, on the other hand, is what you want when you're long options. You own gamma, possibly, or you just own convexity if you didn't hedge it. And so when you're in a straight calendar, you basically usually just want it to run to the short strike at expiration. So what does that mean? Well, that means you're looking for the S&P to get up to 5,800. And, I began the whole live stream by saying it's in view, clearly. I mean, there's a possibility, but valuations are a little concerning at this stage. I don't know, maybe a trade like this in conjunction with that put spread I was talking about earlier. PC, on companies with shareholder-friendly management buying back their shares, could you also include another factor, companies that have high-interest debt that they could refinance? Yeah, so... Well, I don't know that corporate debt expense has come down so much. So I don't know. I mean, look, these companies all have to refinance their debt anyway because they refinance it as it matures, usually. And this is not like refinancing a mortgage back in, pandemic period when rates essentially got down to, you had Republic Bank was, they had ultra high net people refinancing their jumbos sub 2%, right? That's not really happening for corporates. They don't. First of all, that's not the default rate for them. There is still going to be a spread between corporates and treasuries, and treasuries are 10-year treasuries are at 4. So that whole thing that arguably the best example that we saw of companies that were engaged in buybacks and taking advantage of rates was Apple. Apple was selling really long dated debt at very low interest rates and then using the proceeds, which they didn't need to because they were throwing off so much cash, but they were issuing debt just because it was a good play. It's basically a trade when you think about it. If you're trading at 25 times earnings and you can sell debt, good for you, at 3 and change, out long dated, then sure, why the heck not? And you get to deduct the interest. These corporations do that, of course. So, and there was some other accounting funniness that happens with this too, where companies were sometimes able to reflect the discount in rising rate environments, or even just because their own credit had deteriorated, that their own bonds had gone down in value, and they were reflecting that as gains because their liabilities had dropped. But anyway, that's a topic for another day. Michael Kane says, thanks for these sessions. I've held ExxonMobil since COVID drove the stock into the 60s. Now many are touting it on CNBC. What is a good options trade to go long with a 6-month time horizon? Okay, so first things first, sounds like you already own it. The way I think about the integrated oil companies, usually, I think the way most people think about them is, based on their reserves. So you sort of, you take a look at the total value of their reserves and kind of like a price to book way to think about them. Interestingly, Exxon was always amongst the integrated oil companies the one that did the best possible job replenishing their reserves. So you can imagine you got a certain amount of oil reserves, you're selling oil all year long. If you want to essentially maintain a sustainable business, then you have to go identify more reserves to replace the oil that you have sold. And Exxon, for the longest time, amongst the integrated oil companies, was the one that consistently did that. No longer. A couple of potential reasons, and some of that may be associated with the fact that I think that, and maybe somewhat prematurely, there has been a forecast that we're going to move away from oil and consequently, the management of the company didn't think it was necessary to replace it all, and they have looked at other things that they could do. But my thinking would be that if I was going to go out 6 months, I would probably just want to buy. And I'm assuming that you're talking about doing this in addition to the position that you currently hold. And my thinking would be to, buy longer dated call options and, possibly do some overwriting. But let's just take a quick picture of the term structure here. By the way, that same term structure bump that I was just referring to, a lot of things are showing that now. You can kind of ignore the first one oftentimes, because when I show these charts, that often is going to just show the weeklies, and probably not going to get into that. But you could do kind of what we were just talking about elsewhere, which is buy longer dated premium and then just start selling the near dated stuff against it. And that's going to be that first week in November could arguably be the first expiration you could sell, and then just progressively go out. And I would probably do them as a diagonal, because it looks like the stock's got a little bit of momentum now. Let's just take a look at some of the technical indicators and see how those are shaping up at the moment. Actually, one of the bright spots today. So if you take a look at this, these up arrows indicate all of those technical indicators, which would be bullish here. Red ones are the ones that would be bearish. You can see that in general, we see bullish indications are certainly outnumbering. And that's not going to surprise any of you guys, because you can see that the stock has actually caught a little bit of a bid recently. And on top of all of that, broke out of that level. It's not an inconsequential risk that what's going on in the Middle East could cause oil prices to go higher. So it's definitely worth thinking about that. Bob, Amazon analysts downgrades today. Stock close to $1.80. Is that a short-term bottom? Any long call strategy going into the quarterly earnings release on October 24th? Yeah, so interesting. I didn't actually read all of the stuff on these downgrades. Amazon is actually generally a stock that I like. I mean, they're generating tremendous amounts of free cash flow and growing rapidly. They're touching everything, basically. And, the multiple is not really all that crazy when you think about it, if you are looking out in time. So, yeah, at least at that growth rate, right? So it's not insane. Let's just take a look at where options premiums are on a historical basis. I'm just going to stretch this out a little bit so we get a good look at it. Since we're usually looking, when we are doing things like the calendars that we've been talking about, because of the term structure dynamic that we've been referring to, this might be a good situation actually for a strangle swap, frankly. Let's see what the implied move is for earnings. So we're looking at, that's actually relatively small. But remember what I talked about in an earlier live stream, that these implied moves are being thrown off by the fact that the term structures see this November bump. So the way the implied move calculations are done, when you are not looking simply at a straddle that, let's say they don't, but if they reported earnings next week, or you're looking at JP Morgan, they report at the end of this week, you could just look at the weekly straddle, and that tells you what the options market's mean absolute deviation between now and the end of the week is. Functionally, just it is what it is. When you are looking instead to figure out what the event volatility implied by options prices are for some event that is further out in time, and where you're trying to back that number out of two different options expirations, with obviously different tenors, two different expirations would indicate that. One that expires immediately following an event, and one that expires beyond that. The assumption that is made in the models, for example, that Bloomberg uses, is that there's really two volatilities: event volatility, that for the earnings, and baseline volatility, what you expect the rest of the time. But in the real world, it's more nuanced than that. And in this year in particular, that's true because there's so much volatility baked into the election results. So what that means is that the baseline volatility itself has also been elevated, which means the differential between these two has been narrowed, which means that the simple formula that is used to calculate event variance understates it, right? So that's one of the reasons why you might do something like say, okay, I'm just going to look at the implied 1 month volatility in Amazon and see where that is on a historical basis, because it's very likely not unusually low. And we can see it rising here. And the implied move, if you have something like what Bloomberg is doing on your brokerage platform, just bear this in mind. So you can see here, these are the last quarterly earnings releases and the 1 month implied volatility associated with those. And this is going to rise as the event approaches. So you can see what's going on. It's not actually a whole lot cheaper. The implied move calculation makes it look like it is, but it's not. It's because that longer dated premium has been jacked up and the implied is being calculated off the differential. So just something to noodle on there. So therefore, and actually this creates another interesting dynamic, because usually when I try to do these calendars, whether it's a diagonal, a straight calendar, or a strangle swap, which is what I'm going to build for you now, what I'm looking to do is capture at least two of the principal events that could be taking place, which will usually be earnings. But now we actually could use the election as a portion of it if you choose. Now, I would still prefer to capture two earnings on the long side, short just one earnings on the short side, and preferably inside of the election, because that's really quite a big unknown. But if you bought December, which won't capture the subsequent earnings, but will capture the election, you're not going to get quite as much vol crush as a result. So let's just take a quick peek. I'm just going to build this strangle swap here. So let's we'll go out to January, and the average move I think was close to 6%. So let's just use that as our sort of guidelines, if you will, versus a 180 stock price. So we'll use we'll use like a 170, 190. So we're going to buy both of these. We're going to buy the 170 puts. We're going to buy the 190 calls. And then we're going to sell actually, when do they report? Is it the 24th? I think you put that in there. Let me just confirm that. Well, that's what this one says. Someone's getting in my ear. Yeah, this is estimating the 24th. I just want to see whether that's consistent with this. So this is the Bloomberg's got the 25th for that. By the way, Bloomberg also had October 4th for JP Morgan's earnings up until like the middle of last week. So definitely keep a close eye on it. But let's assume for the sake of argument that it's indeed going to be this. By the way, is we know this is probably screwy. So Bloomberg's 25th calculation is a Friday, and I believe they report after the close. So that's Bloomberg is almost certainly wrong. So maybe actually, well, let's see. There's one other thing we can do. We can just see really quickly, again, what does the options market think? Well, this will be revealed by the expiration with the implied volatility. So the 18th, 25th bumps up. And November 1st is still higher. So that 24th, I don't know. Bloomberg's 25th doesn't look right to me. That doesn't make sense. Companies don't report after the close on Fridays. It's not the way that works. So that is all ready to be, you should doubt that straight away. The other thing is that the options market is actually pricing it into the following. So, two ways to think about this. If we're highly confident that it will not fall prior to the 25th, then the 25th expiration is a great sale because it's got a mild event variance built in where there is no event. Sorry. On the other hand, November 1st is kind of your safe play. Wow. Phone ringing off the hook all of a sudden. Okay, so we're going to do that, all right, for safety, right? For safety, we're going to look at this one. So on the call side, that's the 190s. On the put side, that's the 170s. Do I have that all right? Yeah. And we get this trade right here. Now, I would make the following observation as well, which is that I just happen to choose 6% higher or lower as if we were looking at the event precisely. But the truth is, of course, that from now until the actual event, the total volatility that you would expect in Amazon is going to be significantly greater because it is not earnings tomorrow or at the end of the week. So if you wanted something that gave you a better buffer, punch that out a bit and maybe, I'm going to make this more extreme, but just take it $10 each way and you'll end up with something that looks more like that. So now this looks less appealing because it seems like you're making less money in the middle. But what you're really doing when you punch those strikes out is you're saying there's a decent amount of time between now and November 1st when those shorter dated options are going to expire. And the chances that the stock lands right here are not that great because the market's going to continue to move around. So I'm giving myself an opportunity to make money on a bigger move to the upside and a bigger move to the downside, and I'm sacrificing some of the potential profits that I would have made at the money because I am discounting the likelihood that that occurs. So that's kind of a teaching moment thing and something to think about also, because that 6% move, which is about the historical average for the stock, we're really looking at the one-day earnings move, not the move from where we stand today, which is October 7th, out to the possible earnings date, which could be the last week of October. In that case, the move would be significantly greater. But this is a kind of trade that I would probably look at here. And by the way, I think Amazon's really executing, so I'm probably not turning seller on it quite so quickly. Okay, where are we now? November 170 call on DR Horton, and I'm wondering, can I sell a 190 call for the same expiration? Sure. I know that the normal trade would have been a spread, but just, yeah. November 15th expiration. Why is this a stock repair strategy? Let me just take a look at this here. Would have been what? I'm not sure what the stupid mistake is. If you held the ones, are you short the 170 calls? Is that what's going on? To try to collect more premium and just roll up. You can do that, by the way. If you sell a call and it gets to 60 delta or above, you should probably be thinking about rolling it anyway, and you could roll up and out, that kind of thing. So I'm not sure, Al, whether you're talking about being... So I'm just going to throw that on the screen in case anybody else wants to look at it. There we are. Ooh, I've already chewed up an hour here. So Greg Forrest says he's seeing October 24th for Amazon earnings. So remember, folks, we've seen that a lot of the earnings estimates this year have been thrown off because generally speaking, people use algorithms for this, and it makes some sense, right? Because there's a set of companies generally report in the same order around the same time each month when they do report as they have in prior years. So you're going to have to use some formula until the company actually confirms here's when we're going to be reporting our earnings. Because sometimes companies will also pre-announce, right? So we don't know with certainty. We have to take educated guesses on when these things are going to happen. So you're seeing 1024 on your system. Bloomberg's kicking out 1025. It is a leap year. I would just say, go back in time a little bit and double check, because if it really is on the 24th, it might be a buy. That expiration, the 25th expiration, could be a buy because the options markets don't see it that way, right? Oh, Al, okay, so it's a long naked call. What was your stupid mistake? There was no stupid mistake. If you bought the 170 call and the stock's trading 185, that's what we call a win. And actually, if you initially intended to put on the 170, 190 call spread and you didn't sell the 190 calls at the time, it's still a win because that 190 call is worth more now than it would have been. So absolutely, you can do that. The other thing you could do is you could roll, right? So you could take the profits on your 170s and roll up, or roll up and out would be another way to do it. But if you sell the upside call, then you're at least taking back some of the premium. And by the way, you're probably getting close to collecting what you might have done, what you might have spent initially, depending on the time that you bought it. So yes, that's an important point. You can always do that. Adjusting a trade, you buy a call option or put option and the stock has moved in your favor, there are many things you can do. You can roll up in the case of a call or down in the case of a put. You can spread it. Obviously, you could roll up and out to a call spread if that was your initial intent, especially now that we see implied volatilities are higher. So if I bought the 170, the stock's trading 185, maybe I go out in expiration and buy a 190 200 or 190 210, something like that. So things to think about. Do you have time to look into H? Okay, so let's. I don't know if I just shared that one question. So we'll probably have to end on this one just because of the time. So how about aerospace? This one's growing decently on the top line, solid free cash flow, and probably, I think this one was on my buyback list. So they announced, they had a buyback announcement on July 30th. According to this, at least, they haven't repurchased shares yet under the repurchase program, and it's 5% of the float. And full year, year on year, almost 40% adjusted EPS growth for this year, 20% for next year. So now I'm not 100% sure if this adjusted EPS estimate that I'm seeing here accounts for the accretive effects of that buyback. But, well, actually, let's see here. So we can probably figure this out. So that's 1.262 billion. Call it 1.3 billion. And 408 million shares. So that's $3.20 a share. Yeah, so it's actually better than that, right? So, because you've got a 5% in this buyback program, that's 5% of the float. So 318 a share, really adjusting for the accretive effects of the buyback, we're at 335-ish. So 103 a share. That's 30 times forward earnings. And that adjusted growth rate is understated because of this, right? Because we're really looking at 335 a share versus 259. So that's, look, you're buying the stock. So Howmet Aerospace, you're buying this thing at a PEG ratio of 1, effectively. That's the way to think about it. 30 times 335 gets you to about $100 a share. I'm working in round numbers, but we don't know what the exacts are. And 30% year-on-year adjusted EPS growth, accounting for the accretive effects of the buyback. That's a reasonable valuation, put simply. And that's how you do that math, by the way, in case you're wondering. So, for those of you who stuck around all of this time, and by the way, that does demonstrate that not everything is trading at a ridiculous valuation just because the market's equity risk premium is not so phenomenal here. Not that it can't get higher, as I pointed out, 30 times, which is what we were, or beyond back in the tech bubble. And a lot of companies, didn't have real earnings at the time, so that was really, all vapor. But we've seen higher valuations. Doesn't mean the stock market can't go higher here. It certainly could. We're getting into a trickier place here, folks. And there's a lot of things that could contribute to the volatility between now and year's end. So, like, subscribe, comments, questions. As you see, when you send questions like the buyback thing, I will try to address it in future videos. If I didn't address it in this one, if there are some questions I didn't get to, I will try to do it in the next one. So be sure to put your comments in the chat, anything that's really important, and we'll take a look at it when we come back, which we're going to do on Wednesday, 4:15 Eastern. And I hope to see you here. Thanks for watching.